Trading rules that work, 28 essential lessons every trader must master. We've looked at many of them. Tonight, we're going to look at two that we haven't looked at. And I always pass this quote. He has near the fault, dear Brutus, is not in our stars, but in ourselves that we are underlings. And he puts William Shakespeare. He actually talks about in another book how that's incorrectly cited. And he put that there to see if anyone was paying attention. And nobody ever wrote him about it until he revealed it in the other book. So fun little fact there. We are going to start tonight on page 64. If you have the digital copy, it's rule number 8. Never add to a loser. Yeah, I thought some of you guys would appreciate that. Jankowski's that kind of a guy. He likes to put stuff in front of you to see if you're really thinking and paying attention. So he put in here a little quote from George Goodman. If you don't know who you are, the markets are an expensive place to find out. So as we sit kind of on the precipice of uncertainty with our crypto markets and the world markets as an extension, you really have to think about what you're doing if you are trading right now. Because if anybody is trading right now, I would have a really hard time getting a good... I feel like I would have a really hard time getting a good explanation out of you as to why you would be buying for the long term. Anybody who's buying right now, I would expect to be buying for a short-term risk bounce that they're hoping to catch and get out very quickly. If you're not, this is a very important rule to understand. Never add to a loser. We talk about buying the dip and how in a downtrend, in a market that is losing price over time, it makes no sense to buy the dip. And we hear this term thrown around in crypto all the time, dollar cost average, dollar cost average, dollar cost average. And essentially what traders like that are trying to say when they say dollar cost average over and over again is they are telling us that as they've been following Bitcoin, they've probably been pretty emotional, first of all, if they're saying something over and over again without a good explanation. They probably bought here. Bitcoin went down. They thought they were going to lose money, so they probably sold a little bit. Went back up. They probably bought a little bit. Probably held on. They decided to get a little bit more tough with their conviction, and then it dropped, and they either chickened out here or they said, you know what, I'm going to double down. Dollar cost average. And they buy here. So we've bought here, here, here. And what their idea is that if I bought too high and the price goes down, I buy lower, it brings my average price to the middle of those two entries. Well, if I buy down here again and I double my position, my average cost of Bitcoin comes down to meet the average of those entries. So they're continually buying the lower price, hoping that they can drag their entry price down, the average buy of their Bitcoin down, to be in a good position for the long term. Now, this, in my opinion, is completely backwards to how you want to scale in to any position. It makes no sense. And what it tells me is you are FOMO buying what you think is going to be the lowest price every time it shows up lower and lower and lower. You are buying on fear over and over and over. Dollar cost average might as well be something like fear buyer's surprise. Like it just makes no sense to me to try and scale in on a down move. Okay, what professionals are doing is they're waiting for price to come up and they're selling short. Price comes down, they buy and cover. Price comes up, they sell short. Those are very, very, very aggressive, very experienced traders that are trying to make money in a difficult market on the short side. If you are not very experienced, if you are new to trading crypto, or you're trying to learn how to trade the right way and you've been doing it wrong for a long time, let me keep it very simple. When you are moving down in price, you sell the rips. Only when you are moving up in price should you ever buy the dip. Because what buying the dip in an uptrend move does is it gives you a position with lower risk every time you enter than the price that you were just watching occur. So you watched them make this big, huge move. You hopefully sold a little bit here because that's unsustainable. You expect some kind of a correction. And when it pulls back, you buy the dip. That is a good way to buy the dip. So as I come back over to Jankowski here for a second and think about this concept, never add to a loser is another way of saying you don't buy the dip in a downtrend market. Aha. Hopefully that some of you have some light bulbs going on that maybe you had thought of before, but maybe not made that connection. The reason why you don't buy a dip in a downtrend is because you are adding to a loser. You're increasing the risk on a losing position. This goes counter to what our general goal of building positions with the lowest risk possible is supposed to be. So he says, he gives a little insight here, but I'm going to skip down through my notes. And he says, this rule, never add to a loser, is first cousin to rule number 7. And in the case where a trader feels compelled to add to a losing position, the problem is actually a more severe manifestation of attachment. In the case of a loss getting larger than originally intended, or several small losses all adding up to a large cash debit, the problem is probably a lack of discipline or a denial of the actual net order flow. So either you are not disciplined enough to wait and to either have cut your losses short or to wait for more favorable terms of the market, or you are not accepting that you have bought in a position where you are against the order flow, price is going down, you're buying because you think Bitcoin's bullish even though the local trend is down. That's a lack of a denial of the actual net order flow. Zach says, I guess the additional advantage is you even get to hedge by taking profits and waiting for pullbacks. What if the pullback becomes an even deeper correction or worse, a trend reversal? Okay, so Zach, that is starting to get into some more advanced concepts, and that's why you scale out and you don't buy the dip unless they show some support. You want to see them stop at some kind of an area that's important to you, or it's a percentage that's acceptable. So they've pulled back 50% and then the bleeding stops, the volume disappears. That's a sign that, okay, the selling has run out, it's not a reversal. When you're looking at a reversal, you'll see signs that are hitting before that. It's not momentum building. You see signs of exhaustion, and then the selling comes in on the pullback. That's a sign of a reversal. So there's clues that give you indication, depending on the context of where you're talking about the pullback taking place, as to whether it's really a pullback that you can scale into for a better part of the run, or whether it's I need to get a lot of my position out or most of it out because it's a potential reversal I'm looking at, and I may need to look at maybe switching to the other side of the flow. Okay, so he says in the case, I'm going to skip down here for a second. Here we go. The reasoning behind never add to a loser is very simple. Don't throw good money after bad. Very simple way of thinking about it. The only way you or any trader could be in the position of adding to a losing position is if there was a failure to define the risk before the trade was done in the first place. Does that make sense? If you had properly analyzed the risk on your entry and you saw that you were entering in a place where there was overextension, potential for pullback based on your risk analysis, you wouldn't have made the trade at all. So rather than accept a reasonable loss after you entered, the market proved you wrong, instead of accepting that reasonable loss and learning the lesson that loss has to teach you, the trader, you're now making a conscious and deliberate act based not on the fact of the net order flow, but on your own emotional need for something. That need may be a need to get back a loss, revenge, a need to fight with the market. You've got to prove the market that you know better, a need for the market to pay a profit. You need to pay that rent. You shouldn't have traded it in the first place. A need to make a car payment, or any number of little ways of saying the same thing. If you need a trade to work to survive, the market is going to make you hurt. Period. So by adding to a loser, the trader is complicating the process of cutting a loss. So now, not only did you take away your opportunity to get out of the way and cut your losses short, you've increased the blood. You should have put a Band-Aid on and got the heck out of there, but you decided to keep cutting in deeper. You let it get worse. What are you thinking? This act is based on something the market has no knowledge of to begin with, the trader's own emotional need. Okay? So ask yourself exactly why you feel the desire to add to an existing loss. If you find yourself in this position, you bought too high, Bitcoin drops a couple $1,000s, you're thinking about buying again. Ask yourself, why do you feel the desire to add to your existing loss? If you take a step back and think it through, the reason will most likely be some form of emotional attachment to the trade results and some form of unwillingness to do the right thing. You freeze, you get cold feet. You don't want to admit defeat because we are trained, especially in the United States culturally, but also in developing nations around the world that have a high level of competition in their marketplaces. We are taught to fight until the bitter end. You don't give up. You don't give up. Only quitters are losers. Losers are quitters, essentially. In the market, it's more of a battle approach. You have to think about sometimes it's better to run away and live to fight another day. This is war. You need to think art of war, not just I'm at a wrestling meet on the weekend and I don't want to give up and pin the guy, and if I get hurt, it's okay because I can heal from it. That's not what you know. This is war. Like Jankowski says, it's sharks out to get you. If you don't, he's going to eat you. Simon, bullets, not blanks. Exactly. Sunk cost fallacy is a killer. Zach, that's what got me. We've all been there. Okay. So I'm bringing this up for a very important reason because of where we are in the market. I specifically went to this rule knowing where we are in the market because we are very realistically at a point. Let's go back and look at the chart for a second. We're very realistically at a point now where if you didn't buy Bitcoin here, but you bought it anywhere in here, or in here, or in here, and you didn't sell before this happened, unless you just happen to get a buy picked up here, you're probably upside down or you're very close to your break even. If Bitcoin does this, what are you going to do? Do you have a plan? Do you know exactly where you're going to get out? Is there a reason why you maybe thought in the back of your mind, but your ego didn't want to accept it, that maybe you should have taken some off at the table, or maybe you should be considering it now before the potential comes? But I can't take it off the table because what if I take 50% of my trade here that, let's say that I bought on this little entry here after I waited and then I got excited when they stalled and I bought here. Right now, I'd be sitting on my 20%. And you know what? If I take half of that and I take a 10% gain and I lock it in and I take half my capital off of my trade and I lower my risk, I'm also lowering the gains I'm going to get because they're going to go back up here for certain and square this up. And if they do that and they break this level, then I know they're going to go make a higher high. And gosh dang it, I can't give up the 50% of the potential for that trade to make it to here and make me money. If you are worried about losing out on half of this run and you're not worried about taking a winner and turning it into a loser in a single candle like this, you have your mind screwed up. Bitcoin has got you. You have bought the candle tricks and you're ready to give back some of your money that you've made. If you were playing this game well and you had bought here and they had done this, you might have considered adding here when this average was kind of getting support and when the volume, the selling turned off and it started to go buy side. But when you saw this going on, if you had bought down here and you didn't get most of your position out of the way and get your capital out of the way, take your gains out of the way, and only leave on what you could afford to lose, I know for a fact you're not watching this. I know for a fact you're not thinking about this being confirmed by this. I can't keep going forever and ever. Or See you in 2023, guys. We don't know. We don't know how long it's going to take. We don't know how low it's going to go. Why on earth would you, could you, why on earth would you add to a loser? Let me get my 4-hour here. And I don't even need to draw the channel. I'll just do a regression trend. They'll do it for me. Why on earth would you add to a position continually as it bounces down into who knows where? Zach says longs are much larger in number than shorts, and even at this price level. Okay, and so if longs, and we can check that, Bitcoin long to short ratio. I assume this is probably going to be a more popular one based on the likes. Okay, and it looks like we've got a ratio of longs to shorts. So for the positive, that means the longs are going to be greater than the shorts based on how they're calculating this. So definitely on the long side. It looks like you're showing on the long side. Well, to me, Duffy, if we are heavy on the long side and we're in a downtrend, what that tells me is the market is very, very easily ready to clear those longs out, wherever those stops are, wherever those liquidation points are. Because remember, a lot of these people trading right now, here we go. That's the bottom. It's not going to go any lower. How many stops do you think are right in this area? Just waiting for the market makers to come and trigger them, force them out of their positions, force them to take losses, because this is what people do not think about, guys, gals. A stop loss stops you from losing more, but by its very nature, it forces you to accept a loss. Why? Why would you want to accept a loss at a point where if the market goes there, it's going to have a lot of struggle staying for very long, or it's going to find support, or it's going to go even worse? Why would you have a stop there waiting to get hit and then have it take off and emotionally disappoint you? I guarantee you a lot of people out there are doing the same thing. If you are thinking something that everybody else out there is trying to do, you're following the herd, and the herd tends to lose. Okay, so before I run out of time, because I know Scott's going to be back soon, I do want to take a look at my second rule. Let me get a drink here real quick. Rule number 9, don't overtrade. It goes hand in hand with not adding to a loss, because every time you add to a loss, guess what you're doing? You're increasing your trading capital. You're pushing yourself further towards overtrading, which is really bad if you're already overtrading. If you're already exposed more than 2% of your capital to a market that's in a downtrend and you're adding as it falls, you're making a bad situation worse. Your boat is sinking, and instead of bailing the water out, you've got a corkscrew in your hand and you're drilling extra holes. You're helping the ocean take you down. You're giving the market an easier fight to drown you. Don't overtrade. Don't add to a loser. He leaves the quote from Jesse Livermore. I'll say this again. I never made my money by trading. I made my money by sitting tight. I made my money by sitting tight. The weight trade in a downtrend market, when we don't have a safe place to short, when the exchanges that give you leverage are shady as all hell and they take people's money left and right, sometimes the safest bet is to sit tight and wait. He says here very, very astutely, hits the entire section home in a single sentence. Overtrading is the definitive symptom of the net losing trader. Do you find yourself as a net losing trader? Sorry, my screen's still in the chart. Let me pull it back to the book so you all can see the words. If you've ever found yourself in the position of net losses, and I'm sure everybody here at some point, if you've traded longer than a week and any trade that you had in that week wasn't a magic, lucky home run swing, everybody here has probably experienced being a net losing trader. And I can almost bet that at the point you were net losing, you were overtrading. I know I was. He says all the other errors that can increase the net outflow of trading capital from a trading account can be found when you examine the amount of executions done over time. Could you say that adding to a losing trade is overtrading? Isn't it true that too many trades are often done by failing to define a risk? As he mentions in the introduction, most of the trading rules that we're familiar with need to be examined from the perspective of the psychology helping us develop or preventing us from developing. Many people arrive at this rule, don't overtrade, as a wake-up call only after it's too late. For most of us right now, it's too late, only in terms of our past losses. It's not too late to prevent future losses, but we can't go back in the past and change it. What we can do is examine that idea, and what we can talk about is this idea that he says, one thing is certain, ignoring the potential we have to overtrade will almost surely put us in the position where we have overtraded. We have to be realistic and honest that we all do it. We've all done it before. We'll probably all do it again. And as soon as we notice we're doing it, we need to look for a way to de-risk and scale back. Not when it does the bounce, not after it falls and gives me a further loss. The moment I realize that I am imbalanced in where I need to be as a trader for comfort and for safety, I need to rebalance. If I don't, the market's going to do it for me, and 9 times out of 10, the market's going to charge me more than I want to pay to do that. He goes on to say, a key to cutting our losses is selecting which opportunities are the best profit potential for us personally. And if the truth were told, we really only need one market. The fact that we can actively participate globally at any moment contributes at least in part to the problem of overtrading. This is doubly true in crypto. You know, in equities, you have after hours trading, you have futures that have made the problem worse of overtrading. Crypto, you don't even need all that stuff. They have it, but every coin trades all the time. Bitcoin never turns off. The exchanges don't turn off. So because of this availability, a lot of traders, especially in the beginning, make the mistake of thinking that overtrading only means excessive trading in a particular market. They think I'm only overtrading if I have too many altcoins. They don't think about too much Bitcoin as overtrading. Who needs anything else when you can trade unleveraged Forex on Kraken? That's right, Bizarro. You can make half a pip every week.
That's all Bizarro.
But the thing you got to understand here, guys, is overtrading is not so much an amount of money you have in play in a particular market. Overtrading is when you have too much risk at play at any given time based on the current market conditions. And I want to finish up with the last part in the end here. I had some more I wanted to cover, but we got so good into some of these points. I encourage you all to go back and read this a couple of times because he makes some excellent points about this idea. But he says, following Rule 9 can boil down to answering this question as honestly as you can. So as I read this, think about the answer to this question and how it works for you. How well do I know what I am doing? And am I willing to admit I don't? If the answer to that question is anything other than I know exactly and I don't need to change anything, you're most likely overtrading in some form or another. Think about that. If your answer to that question is I know exactly what I'm doing and I don't need to change anything, you might want to go look at how much you have at risk right now at this very moment. Because you're either trading too many markets, trading without knowing your exact probabilities, trading too many alts, you're in alt USD trades, alt Bitcoin trades, you don't know the difference between the two, you're not following Bitcoin on top of those alt trades. Reducing your exposure or knowing when to stop executing, or a little of both, depends on your willingness to control, guess what? Yourself. Unwillingness to control your behavior is what leads to breaking every other rule. It's you. It's all you. Look in the mirror. You're the reason. It's your fault. Overtrading is the most important symptom to look for. You want to get better? You want it to stop being your fault? Or you want it to be your fault that you're winning instead of losing because it's your fault no matter what you do? Go and look at what you are risking and ask yourself, am I over trading? Is there more on the table at play than taking a 2% hit right now if this market goes and does the deep dive down into the nether regions of nobody wants to see it for the next year and a half Bitcoin price? Are you ready for that?